Okay, why does an increase in interest rate results in an increase in exchange rate? Everything else being equals. Here E is the exchange rate, which is foreign dollar per domestic dollar. That's the unit. Or let me be more concrete. Say it's US dollar per Australian dollars. So Australian dollar is domestic currency. Okay, the intuition is, so here is domestic economy, interest rate goes up, so everybody want to invest in Australia. So foreigners, they hold US dollars, so they need to exchange US dollar, the US dollar for Australian dollar in order to invest in Australia. To do so, in the foreign exchange market, so investor will sell US dollar and buy Australian dollar. This implies demand for Australian dollar goes up. Then Australian price of Australian dollars or exchange rate goes up. That's the intuition. Let me be more precise. Suppose we know Australia and US and today. In Australia, we know the interest rate is I, and the US is I star. And we know the exchange rate, 1 Australian dollar can exchange for E US dollar. And tomorrow, we know that we have an expected exchange rate, 1 Australian dollar is expected to exchange E here denote expectation. Okay, that's the information we have. Now I have $1 in hand. I have two options. Option 1, I can invest in Australia. Then today I invest $1. Tomorrow I get 1 times 1 plus I Australian dollar back. Alternatively, I can invest my 1 Australian dollars in the US. To invest Australian dollar in the US, I need to exchange Australian dollar for US dollar, and $1 can exchange E US dollar. Then I invest this E US dollar in the US, which have a rate of return of have an interest rate of I star. So tomorrow I can get E times 1 plus I star US dollar. Then now that's an US dollar I wanted to convert to Australian dollar. So divided this by expected exchange rate. And this is in Australian dollar. So if 1 is this is big, 1 is bigger than 2, then everybody will invest in Australia. So they will exchange all investors will exchange US dollar for Australian dollar. Australian dollar will appreciate. So this will increase until it becomes equal. Or alternatively, if 1 is less than 2, then everybody wants to invest in the US. So investor will sell Australian dollars for US dollar. So Australian dollar will depreciate. The price of Australian dollar goes down, so this goes down until it reaches equality. Okay, and we call this, now if 1 is equal to 2, then there's no opportunities for arbitrage, so no arbitrage. So in the end, there's no opportunity for arbitrage, which means this the value of 1 is equal to value of 2, or 1 plus I is equal to E times 1 plus I star over E. Or the rearrange terms, we get E is equal to 1 plus I over 1 plus I star times EE. And this is called interest rate parity. So now it's easy to see that everything else being held constant, okay, an increase in the interest rate in Australia results in Australian dollar appreciate, an increase in exchange rate.